Yo, what's really good, people? Welcome back to the channel. Today we're going to be talking about the top movers and fallers. We're going to be talking about the UK sliding into a recession, and I'm going to give you my slight predictions on the UK market for the second part of the year. So yeah, you want to know all of that plus more, please like, comment, subscribe, help the channel get to 8k subscribers. Follow on Instagram and Twitter at Invent Investors. And if you're wondering what app I'm using the Freetrade app to invest. If you want to invest using Freetrade, click on the link, sign up, deposit £1, and you will get a free share of up to £200. But yeah, if you are watching this video and you do take value in these videos, please smash that like button. I would love to see another 300-400 likes on this video. Thank you to everyone else that has been supporting on the previous videos as well. And if you are new to the channel and you're not yet subscribed, smash that subscribe button in the bottom right hand corner and support the channel. But listen, let's get straight into the top movers for the week. Before I even get into the top movers, you can just see from the 7-day graph here how turbulent this week has been. You know, it's gone up, it's gone down, it's gone sideways, it's gone back, it's gone round, it's done a loop, it's done everything this week. So yeah, it's been a very turbulent week, and I think there's a lot of things to cover off. So let's get straight into it so we can understand a little bit more about the market. So the first top mover to talk about this week is pineapple. Pineapple's gone up 3.42%. If you are new to the channel, I'm quoting a percentage that you're not going to see on your screen. Is from my Simply Wall Street portfolio. It just gives me a bit of a clearer indication to the performance of the stock for this week. So the stock has gone up 3.42% for me this week. I personally still believe that Apple is riding the stock split news. So, you know, they announced obviously they're going to be doing their 4-to-1 stock split a couple of weeks ago, and that's going to take effect from August the 31st. A lot of you guys have been asking me information about stock splits, you know, if you should buy now, if you should buy after the stock split, you know, what does it mean? And obviously Tesla also announced the same thing for a 5-to-1 stock split. And you guys have obviously been asking me, you know, all of those questions, and, you know, trying to see if there's a way you can time it in order to make better money. Now, I'm going to give you some, you know, data and information about stock splits, just to kind of help you understand, you know, some of the pros, the cons, the benefits, and a little bit of the mechanics as well. So one thing to let you guys know is that when a company is doing a stock split, technically speaking, the valuation is exactly the same. All that's happening is if a stock is 400 and they're doing a 4-to-1 stock split, the stock is now going to be 100, but you're going to have 4 shares rather than 1 share. The actual market cap, the actual value, the fundamentals of the business, nothing actually has materially changed with the balance sheet or anything to do with the value of the actual business. However, the perception and the sentiment of the business, particularly around the fact that more retail investors can buy because the actual unit price per share is at a lower amount, tends to have a favorable impact to the stock market performance. So yes, you may see a higher performance, and yes, obviously the stock might continue to rise because of it, but no, it doesn't mean that the fundamentals of the value has changed. But I will give you some interesting information. I'm reading this from the Balance, the links will be in the description. Perhaps the most compelling reason for a company to stock split is that it tends to boost share prices. A Nasdaq study that analyzed stock splits by large cap companies from 2012 to 2018 found that simply announcing a stock split increased the share price by an average of 2.5%. In addition, a stock that had a split outperformed the market by an average of 4.8% over 1 year. So what that's basically telling you is that just by the rumor, or just by the news rather, of a stock split being announced, the average of those companies basically had a share price increase of 2.5%. So that's definitely, you know, worth noting and showing you the value of, you know, announcing that a company is going to do a stock split. But also it mentioned that over the course of that year, those companies typically beat the market by 4.8%. Now, you can potentially find that second part of the data a little bit miscued, because typically companies that do stock splits are going to be higher value growth stocks that, you know, companies whose share price have gone into really extreme figures anyway. So, you know, they might have outperformed the market for a number of factors. I wouldn't say the stock split is generally the contributable factor there, but it's just worth knowing. So yes, Apple might increase throughout the course course of the year. I think they're going to increase just based off their fundamentals alone, to be honest. Tesla is another one that's probably going to increase just through the hype and the future prospects. But if you want to ask me directly, do I want to invest in a company because of the stock split? My answer is no. Will I invest in a company just as an outcome of the stock split, or potentially based off the future prospects? I will take the same approach that I've been taking, prior to the stock split as well. So that's my personal take on that. Now, with regards to the Apple stock split as well, just some dates you need to have in your calendar. The record date is August the 24th. What that basically means is that's the date that determines which of the current shareholders are entitled to receive the additional shares from the split. So all of the current shareholders by August the 24th will be entitled. Then you've got the split date, which is August the 28th, 2020. The shareholders that are due to split are going to get the split after the close of business on this date. And then you've got the X date, which is basically the 31st of August. This is the most publicly known date, and that's when the new shares will be trading at the new split adjusted price as well. So those are the dates to know in terms of whether you want to buy the shares, whether you want to sell the shares. If you buy the shares during that period, then you are buying it at the current price. If you sell the shares, you are selling it at the current price. But obviously, if you buy and you have it from that period afterwards, you'll be having it at the new split adjusted price. So yeah, me personally, Apple is obviously a business that I'm not in love with. I think that's the wrong term, but I'm more than comfortable holding. I think it's obviously extremely strong business. Its services business is doing fantastically well. Its iPhone business is actually starting to surge up again. And I think, they've just got a lot more things to do. They've got a fundamentally incredible balance sheet, and, a lot more prospects for the future. So yeah, I'm up 47% for the year. I do want to invest more into Apple, so I will see when and how I will do that. Probably will wait till after the stock split. Maybe there'll be a slight dip in the price as everyone's kind of seen the rally from the stock split. But yeah, Apple is definitely a stock that I'm going to be continuously holding. It's done 4 stock splits previously, and this is obviously the fifth one, and I'm going to continue holding it for the long term, but I'll just be adding more money into that, in due course. Now, the next top mover to talk about hasn't been a top mover in quite some time, so you'll be very surprised, is Lloyds. So Lloyds has gone up this week 4.19%, and there's no direct reason why Lloyds has gone up this week, but I am going to talk a little bit more about the recession stuff in the UK market later, which I think Lloyds being the biggest bank within the UK, or at least the biggest mortgage lender within the UK, I think obviously has benefited from some of that sentiment, which I'm going to talk a bit about later on. So in terms of company specific information, I don't think there's anything specific that Lloyds have done in order to cause it to go up 4.19% this week. If you're looking at analyst recommendations, currently you've got 5 analysts that are saying it's a buy, 4 analysts are saying a hold, no analysts currently saying it's a sell, which would make sense when you consider how far it's gone down over the last year, and quite for some time actually, to be fair. So it's no point selling it. If you already have the stock, you might as well just hold it and see what happens. However, I was looking around, and Stockopedia, which is a website, I'm not saying it's not one of my top websites that I go to, but it is a website that I do frequent on occasion. They do say that they think Lloyds is a value trap. So obviously I'm a holder and investor of Lloyds, but some of you guys, I want to give you, balanced information, and Stockopedia is basically saying they think it's a value trap. And a value trap is basically a stock that appears to be cheap for a sustained period of time with low multiples. However, if you buy them expecting it to rise and expecting the fact that you're getting a value, it actually might just continue to drop further. And I think that's been, definitely the case with Lloyds for a long time. However, I just think when you actually look at the fact that it has made profit quarter after quarter, but typically it's due to loans or COVID or PPI or all of these different, or Brexit or different, macroeconomic factors has caused it to have to spend that money and basically take away its profits. I think that's had a significant impact. Obviously the dividends thing I think has had a significant impact. I think I can fairly judge Lloyds in an environment when the dividends have returned for say a sustained 1 year period, and then I can then fairly judge to see actually is Lloyds a good business to hold or not a good business. Right now I still assume it's a good business because I'm looking at the macroeconomic factors. I don't personally feel it's a value trap. I do feel that you don't necessarily need to just put a whole bunch of money to Lloyds now. Maybe dollar cost averaging is a better way to go, but I'm still going to hold into it for the long term. So we shall see what happens there, and it's definitely something that I'm still going to hold. But yeah, good to see Lloyds in the top movers at least. Now, the top mover for this week is going to be very interesting because it was in the top fallers for last week, and now it's in the top movers for this week. So I'm going to scroll down. Is Virgin Moolah. So Virgin Moolah this week has gone up 8.77%. Again, I think there's a similar macroeconomic factor which I'm going to talk about later on in this video, so stay tuned to the end for that information. In regards to company specific information, they launched their home buying app this week. Do you remember a few weeks ago we talked about Virgin Money doing a home buyer's application to help people through the mortgage buying process? You can't actually buy a property or do a commercial mortgage through or a retail mortgage through the application, but it's a way to kind of digitize. And then I mentioned in that video that I think Virgin Money is kind of at a nice intersection between a traditional bank but also the ability to be a bit more modern, be a bit more neobank, and actually digitize. So it's got more assets than say a Monzo, but it's got more potential to have a better digital experience than say a Lloyds, HSBC, Halifax, incumbent banks, etc. So I think it's very, very uniquely positioned. It was in the top fallers last week because obviously the mortgages business dropped by about 1%. A lot of no new mortgages were being taken up during the whole Divock 91 situation, and we also talked about their provisions for loan loss was about 74 million. So all of the deferred payments, loan losses, defaults, credit provisions, etc. So that obviously caused it to be in the top fallers last week, about 2%, but this week has gone up 8.77%. Listen, let me talk about the bad news about Virgin Money. Over the last 12 months, Virgin Money has dropped 39%, which is obviously quite significant. Shareholders have lost an average of 19% per year for the last 3 years, in a climate where the UK market on average for the last 3 years has fell 7.9% per year. Virgin Money shareholders have lost about 19% on that, so it's actually tracking worse than the UK market. However, if you want to find some good news in all of that, it's gone up 8.77% this week. As I mentioned, it's gone up 22% in the last 3 months, which I think is something significant. There's no 3-month tab here, so you can't really see it, but if I go to the year tab, you can kind of see the little rise from this bottom to here. That's about a 22% increase over the last 3 months. So if you did get in at this time, then for you, you're probably in the green for Virgin Money, which would be good news for you. There's about 22 analysts that cover Virgin Money, and their combined future growth forecast is about 75%. That's higher than all of my growth stocks, all of the US tech growth stocks that I've got. Not one stock is higher than the growth forecast for Virgin Money. So as far as growth stocks in the UK goes, Virgin Money technically falls within that category. If they're saying that within the next 1 to 3 years they expect 75% growth, like they're expecting this business to nearly double within 1 to 3 years. So there is a lot of strong prospects. The revenue has gone up 14% on a yearly basis, although obviously the profit wasn't going up, which is partly the reason why the share price was falling. Now, in terms of my portfolio and how Virgin Money basically constitutes my portfolio, it's actually only 4.2% of my overall portfolio. So, what I basically mean by that, look at my portfolio as an overall here, or, including the basic account there. Virgin Money at the moment sits around 4.2% in terms of my overall portfolio holding. Now, if you compare that to Lloyds, Aviva, Cloudflare, which are like 10% of my portfolio, Microsoft, which is 9% of my portfolio, it's not that significant in terms of what I actually hold with Virgin Money. So it isn't the worst case, but I think I will definitely continue to hold this stock for the time being. It's one of the ones where I feel like I'm a bit on the fence with, but actually just doing a little bit more research into this week and actually just looking at it because it was a top mover and just saying, if you were to buy the stock today, would you hold it for the next 1 to 3 years? If this was a brand new stock, the answer for me would be yes. So because obviously I already hold the stock, there's probably no reason for me to be hasty and get rid of it. I do actually feel like it could be a good business over the long term. There's nothing forcing me to put in a whole bunch of money into it. I can just dollar cost average £50, £100 or something smaller into the stock on a monthly basis, and then hopefully, you know, it starts to grow over the next year or so. So yeah, very, very interesting to see Virgin Money being the top performer for you know, the top mover for a week, because I don't think that's ever happened, to be honest. Maybe it's happened back in the day, but I can't remember when it last happened. So it's good to see that. Now let's get into the top fallers. The first top faller to talk about is PayPal. PayPal has gone down 3.61% this week. There's nothing to talk about for PayPal. Earnings was about a couple of weeks ago, had a phenomenally good earnings, and it's just retracted a little bit this week, and there's no real clear reasons why. So I'm just going to move on. So yeah, PayPal was the top faller, or one of the first top faller to talk about. The second top faller to talk about this week is Uber. So Uber has gone down 7.42%. The main reason I believe Uber's gone down is because they've basically announced that they will suspend their service in California due to the regulation of how they classify drivers as employees, or how California state is requesting them to classify their drivers as employees rather than independent contractors. And so because of that, you know, that's going to be quite significant. California, the state of California, is a very big market for Uber within the US. You know, they dominate more than, you know, government taxis. They dominate more than Lyft. And so obviously, you know, them having to restructure their business to basically call those drivers employees is obviously going to take, you know, significant organizational change if they are to do it. And so for the time being, they said, you know what, we'll just have to suspend. And obviously that's going to then hit their revenues quite considerably. So share price has basically dropped from that. You know, I wanted to have a look at, you know, their insider activity, because I think with companies like Uber, who's going through so much regulatory pressures at the moment, going through so many different things in terms of buying different businesses, selling different businesses around the world, making people redundant, all of the job losses, there's so much going on with Uber as a business. I wanted to kind of have a look at what is the insiders doing, and how can I use the insider trading as a indicator to the performance of the business, or the outlook of the business. And it doesn't actually look that good, if I'll be honest with you. It doesn't actually look that good. If you look at institutions, companies that hold Uber as a stock, so institutions that hold Uber as a stock, has sold over £32 million worth of shares over the last 9 months, versus buying only 6.7 million. So that's quite considerable. It's like, you know, 6x in terms of selling versus buying. You know, that's the equivalent of 940,000 shares being sold versus 250,000 shares being bought. There's been a similar trend for insiders. I think it's actually been, you know, actual individual insiders is even higher than that, which is quite considerable. Not by the share amount, but in terms of the ratio between buying and selling. There's a lot more insiders actually selling than buying. So Uber right now is quite deflated, and I think probably there's going to be a bit more of this deflation to go. So yeah, I'm sitting at about 8% loss. I never put that much into Uber, to be fair, which is okay. I wouldn't even call this dollar cost averaging. I just kind of chucked money in sporadically, and again, it doesn't make up a big part of my portfolio, but I think Uber's one of those businesses where you're going to have to decide whether or not you see it long term being able to perform well. And when I look at the Uber Eats business doing extremely well, and when I think that, you know, Uber mainly had a bad year due to the Divock 91 situation, it mainly had a bad year due to all of this regulatory pressures that it's been having. You know, once this actually gets circumvented, then Uber potentially can go back to being a good company. And you know, there is a lot of analysts that have a price target for Uber still in the $50 region. Do you know what I mean? Which now is like 40% up from where it is today. So I think long term it could still do well. I'm more than happy to hold Uber, and I think I probably need to chuck a little bit more into it to take advantage of the lower price. Definitely not selling Uber, that I can tell you, but I'm kind of in between a buy and a hold at the moment, just holding, seeing what happens, and then maybe buying more in the next few months, once, you know, things start to be a bit clearer in terms of the future outlook, especially for the California situation as well. Now, The main top faller rather, to talk about this is, it's crazy that this stock is the top faller for the week, but I mean Virgin Money was the top mover for the week, so yeah, it's all happening. And that stock is Centamin. So Centamin has gone down 8.63% this week. Centamin's had their earnings update this week. Now their earnings update was absolutely incredible. Their earnings is incredible. Centamin joins a list of stocks like Microhard, like Cloudflare, like Okta, like a whole bunch of stocks that basically Netflix, Snapchat, I can't remember, I listed them all in previous videos, that have had a fantastic earnings, but the stock has dropped. And Centamin is now another stock to join that list. Centamin's gold sales rose 56%. Their profit went up from 56 million to 191 million. Their revenues up also 56% to 449 million. Gold sales up 22%. They obviously have announced that they're going to be reinstating their dividend, and their dividend went up from 4 cents a share to 6 cents per share, making it a dividend yield of about 4.55% based on, you know, today's current share price. Now, in terms of why Centamin has fallen, I think the ex-div maybe had something to do with it. I think the macroeconomics of the fact that gold is slightly going down, so we saw gold has reached its peak, but it started to fall down over the past couple of weeks, or past, you know, maybe just over a week, let alone even a couple of weeks. So I think obviously, because I think Centamin is so intrinsically linked to the price of that gold commodity, then I think that's had a factor on it. But if you want to talk about the ex-div, Centamin went ex-div on the 30th of August. You know, their pay date is the 11th of September. For me personally, I hold 1,286 shares of Centamin, so that basically means that I will get roughly about £60 in September as a dividend payment. When you look at the price targets, on average the price target for Centamin is £2.50, and currently it's £2.01, so that's still 20% up. So, you know, I'm definitely going to be adding more money to Centamin. Centamin is a stock I'm not invested in quite some time. If you look at the last time I actually bought any Centamin shares, it's the 2nd of December 2019, over 7 months ago, that I bought my last, you know, Centamin share. So it's gone up quite significantly since then. That share price around that time was about £1.12. So it's definitely gone up. I'm sitting at 77% profit, so I'm definitely happy with the performance for Centamin. But I do want to increase my holding into Centamin. It's a cyclical business. It is a business that is going to drop heavily and then rise heavily. I probably should wait till it drops heavily, but I think it probably will reach that price target by the end of the year, now that we are in a recession and some people will still hedge with gold and put their money into gold. You're seeing what's happening with cryptocurrency at the moment. Ethereum's been rising, Bitcoin's been doing well. So, you know, gold, traditional investors still like to put money into gold when there is a recession climate. So I think over the next 6 months, Centamin is still going to do well. So I think I definitely want to ride that a little bit and see what happens. So yeah, I probably will add a bit more money into Centamin on my next round of investing. But yeah, you know, for a top faller to have such positive news and positive information, I'm really unsurprised, because this year from a stock market perspective has been, you know, incredibly telling, and there's been so much kind of inconsistencies. It's very, very, very hard to predict what's been going on. But yeah, it is what it is. Centamin, the top faller of this week, but you know, most certainly a stock that I love holding, one of my day one stocks, and I'm definitely going to keep doing that. Now, in terms of the recession, what has happened this week? The UK economy has slipped. What should I put onto screen before I talk about that? Maybe I should put the FTSE 100. So yeah, let's put the FTSE 100 on there. Let's show 7 days, or Vanguard's done all right. I'll put a month graph up. Who knows? Let's put that one up. So what's happened? The UK economy has basically slipped into a recession. It shrank by 20.4% in the second quarter of 2020. It's the worst quarterly slump on record, pushing the country into the deepest recession of any major global economy. Worse than France, worse than Italy, worse than Germany, worse than the US. It's been the worst of the major economies. Initially, when the news broke that the UK has gone into a recession, the actual shares were flying off the shelf. Like shares of FTSE 100 stocks were flying off the shelves, and I mean by people were buying haphazardly. In fact, it closed up about 2% for that day. Now, obviously, it started to go down. I think one of the reasons why it actually was going up, let me just talk about it going up first. I think partly the ex-div, so a lot of companies were going ex-div on like Tuesday and Wednesday, and that was the same time when the news was announced. So I think people were investing because they wanted to actually get next dividend payments. I think some people were probably incorrectly misjudging the recession and just thinking, if I buy now, I'll be rich. And actually, that's not generally how recessions work. You have to buy continuously throughout, the 6 months or however long we are in the recession. I think also the recession was partly priced in, not even partly, I think it was majorly priced in, to be fair. I think some people just wanted confirmation of what the actual figure was, and they thought, now that I know it's 24.4%, no longer do I need to speculate. I can now just start buying and just continue my investment, etc. However, on Friday, it actually started to fall quite badly. Now, there is a few different reasons and theories floating around about why the UK market was falling on Friday. Some people think it's due to, obviously the dividends passing by that time. So, typically, obviously, the shares and the value of those businesses will drop by the amount of the dividend that they're paying. Some people are attributing it to Chinese data. So Chinese production data came out, and that wasn't really good. And so people are saying it's linked with the UK. Some people are actually saying that more countries were added to the UK quarantine list. So I think, 6 more European countries were added to the list, that if you fly back from those countries, you have to self-isolate for 14 days. So some people are saying it's due to that. But yeah, there's a whole bunch of reasons why potentially it fell quite considerably over the last day. So yeah, initially when the recession was announced, it jumped up. Then towards the end of the week, it started to fall down quite considerably. It's just letting you know, like, look, the stock market and the economy is really, really far from linked. Like, it's really hard to kind of correlate the two. Just to give you some insight, in a normal year, if everything is just all as it's meant to be, about 70% of revenues generated by FTSE 100 companies actually come from overseas. So the majority of UK revenues from UK businesses don't actually come from within the UK. Let that be known. It comes from overseas investors and overseas funds and money, because the UK is primarily a service-based economy. So things like finance, retail, entertainment, it accounts for like 3/4 of the UK's GDP, whereas manufacturing and production, which is what typically should be the metrics for GDP, is only like 21%. If you think about countries like India or countries like Brazil or countries like Germany, they produce whatever it is, from cars to commodities to meat to milk to whatever it might be. Those are companies that you basically are synonymous with producing something that the world wants. With the UK, it's typically not that. We don't really produce that much in the UK. Maybe, bangers and mash and rhubarb and custard pies or something, but we don't produce that much. We're more of a service-based economy. So, I think that when you look at the UK from that perspective, we are very, very dependent on the success of other economies as well. And if other economies typically have, things not going so well for them, that can have quite a big knock-on impact into the UK as well. When you look at the whole Brexit situation, that is still a major factor. Let's not forget about it. It's not obviously taking the headlines for the last 6 or 7 months because of the whole Divock situation, because of the whole recession situation, furlough, unemployment, all of that other stuff. But that Brexit stuff is, I think the receipts are going to be cashed in soon on that, and that's going to have a major impact. I mean, Brexit alone has cost the UK about 17 billion since 2016, so it's cost the UK economy quite a lot. And obviously when it actually does happen, it's going to be quite significant, considering that EU trade for the UK is like 43% of all of our exports. So if we get higher levies on that, and all of the other factors that we've talked about probably like about a year ago now, to be fair, it could look pretty bleak for the UK, to be honest, if that all comes into fruition. When you look at the UK job numbers, we're expecting, or the Bank of England, not we, I'm not part of the Bank of England, but the Bank of England is forecasting that, the job numbers or job losses, unemployment goes to about 2.5 million by Christmas this year, which is going to be significant. A lot of companies that are currently, keeping staff on due to the furlough scheme and the government paying that's going to end in October. Although there are incentives for those companies to keep staff on, there's going to be probably more of a financial incentive for them to let them go when they look at their own balance sheet, based off what's basically been happening. So I think the UK economy is in a very precarious position, is what I would say. I did a poll on my Instagram trying to get you guys flavor in terms of what are you guys going to do based off the new recession news about the UK. Some of you was like, I'm going to be sensible and just dollar cost average into UK stocks. Some of you are going to be like, I'm just going to squalay the UK completely and I'm just going to focus on US stocks, etc. Some of you see this as a trading opportunity, you're going to start shorting the market and doing a little bit of that. I think there's so many different directions you could potentially go in, because as I say, the UK is in a very precarious position, and I just don't think it's very easy to predict what's going to happen with the UK. Stocks might continue to rise because a lot of this might have already been priced in, but stocks might also fall if there's negative sentiment in other economies, and also if employment numbers continue to drop significantly, then we might see a worse outcome. In terms of me and my prediction, I actually think, and this is going to surprise you, I actually predict that the prices of UK stocks, I'm not talking about the economy here, just stocks itself, I think share prices are going to rise this year for the UK. That's my prediction. I don't think they're going to get lower. I think they're going to, on average, rise. When I look at Aviva, what Aviva was doing before the ex-div, it was rising quite well. It was sitting at about -2%, and then the ex-div came and obviously shot it down to 7%. Legal and General was in profit by 3%. It's now less. Lloyds, obviously we don't even need to get into Lloyds, but I think UK stocks on the whole were actually doing quite well, the sort of run up to this news, to be fair, and I think it's been heavily priced in and heavily discounted. So I actually feel that UK stocks is probably going to rise this year, and that sounds crazy considering we've just announced that we're going to be in a recession, but I just think we've had a crazy year so far anyway. Do you know what I mean? And I think this year's proven that we can't really predict what's going to happen. So, if I say it's going to fall, I think, if this was 2008, it would be obvious, but I just don't think it's that obvious in 2020 what's going to happen. Me personally, I'm still going to focus on my US stocks. That's definitely still my main focus. However, I will probably dollar cost average a bit more into my UK stocks at the moment, and then the ones I don't believe in, I'll obviously get rid of them, and the ones that I continue to believe in, I will be holding them for the long term, and we will just monitor and follow that progress over the next months and coming years, etc. I probably will also start day trading again, and actually seeing if I could take advantage of some of the rises and falls if that actually happens as well. So yeah, we'll see what happens there. But yeah, hopefully you found this video useful. If you did, like, comment, subscribe. Please smash that like button. Please subscribe if you're new, bottom right hand corner, and I will catch you next week with another investment video. Take care, guys. Peace.